All right, moving on with our big, massive series on using our financial statements to analyze our business and our business health. So there's a couple things we're going to cover today, and we're going to cover a group of ratios called activity ratios. And y'all, here's the thing you got to remember. These ratios, they're just like industry standards, right? They're accounting standards. You can turn anything into a ratio. You can look at any two numbers on any of these documents and divide those numbers and get a result. And you can get useful information. So don't go around thinking that these are the only ratios you can come up with. I guarantee you there's a ton more out there that we're just barely touching the surface on. And you can always come up with your own. If there's something in your business that you think is important and you want to watch, hey, watch that number, turn it into a ratio by dividing it by some other number. It's not like these things are physical laws that happen. These are just kind of standards that we look at. So the first activity ratio we're going to look at is the inventory turnover ratio. And this is done by taking the cost of goods sold and dividing it by the average inventory. Now you get the average inventory way over here off of our income statement. We have an inventory in January 1. We have an inventory on December 31. You just average those two numbers together. And of course, you just do it in the spreadsheet, right? You've got the spreadsheet, so the spreadsheet does the math. Doesn't really matter what the numbers are. If you just enter the formula, you'll have it. Let me double click on this so you can see it. So H8 is where the beginning inventory is hiding over on the income statement, and H11 is where the ending inventory is. And you just add those together, throw in some brackets to make sure you control for order of operations, and divide by 2, and you get the average inventory. Now, the textbook I was using to build all of this information said to just use inventory. And I thought, what do you mean by inventory? And so I dug around a little bit and I learned that we should actually be using the average inventory. Well, why is that? Well, because the ending inventory and the beginning inventory are an incomplete picture of what's going on during the time period that we're studying, whether it's a quarter or a year or whatever the case may be. So the average inventory, the beginning plus the ending divided by 2 is the proper number to use. So we're going to take the cost of goods sold, which is again on the income statement, and we're going to divide that by the average inventory, and we get this number, the inventory turnover ratio. And here it is. It's just B78 divided by B79 on my spreadsheet. Dividing is really easy on a spreadsheet. And we do it again for the next year. Here's what we're seeing. The inventory turnover ratio is 3.15. That means during the accounting period we're studying, we turned the inventory over 3.15 times. We had slightly over 3 turns. And, well, now the question is that a good number or a bad number? Well, it depends on the business. Every business is a little bit different. Some industries have very fast turnover ratios. Some have very slow turnover ratios. But a great way to understand that is to simply calculate the days items spend in inventory. And that's simply done by taking 365, the number of days in a year, and dividing it by your inventory turnover ratio. And so we see this turning the inventory every 3 times a year means it takes roughly 116 days to turn the inventory over. And y'all, this is kind of important because inventory can soak up your cash, right? Inventory is one of those current assets, and your goal is to turn that current asset into cash. And if you're not turning the inventory, you're not turning it into cash. That inventory has got to flip. You got to flip it. You can't just sit there. Having goods sitting in inventory, not going out the door, is not how you run a successful business. Now, I don't know on this particular business model, this particular industry, if 116 days is a good number. But I know that the number got better, meaning we turned it over more. We went from 3.15 turns in a year to 405 turns in a year, which means we had a 90-day turnover ratio. So we went from turning it slightly more than 3 to slightly more than 4. Y'all remember, this days in inventory, we can modify that. If this were quarterly, we would divide this 365 by 4 for the 4 quarters in a year. Don't forget that. It's not necessarily going to be about 365. It's about how many days the accounting period covered. So the way I look at this is we see an improvement. We see the business do a better job of turning the inventory, and that's a good thing. I don't know if 115 days is good or if 90 days is good, but I know that 115 days is worse than 90 days, and so we see some improvement over time. We're clearing out that inventory, turning it into the cash that we so desperately need so that we can meet our obligations in our business. The next one we're going to look at is called the accounts receivable turnover ratio. Sometimes we call this accounts receivables. I have no idea when it should be plural and when it should be singular. Perhaps if you run across an accountant, you can ask them when it should be that way. So what I've got here is kind of an attempt to get to the core of what we're trying to talk about here. The actual thing you should be doing is dividing the sales you made on credit during the accounting period by the accounts receivable. Now, we probably ought to be using the average accounts receivable, so we need a beginning accounts receivables and we need an ending accounts receivables. I don't have that information on the spreadsheets here in front of me, so I'm just going to use the ending accounts receivable that you can pull off of the balance sheet at the end of the relevant year. And I just assumed that we had either 10 or 15% of our sales were on credit. That's probably not a good assumption. The reality of business is that most of the time, when someone buys something from you, they don't pay you, you deliver it, you invoice them. They get the invoice, they pay the invoice, which means you are extending credit to them. You send them the invoice, they've got 30 days to pay it from the date of the invoice. And so really the sales on credit is probably a bigger number, but I just needed a number to work with. And you would have to actually make sure you kept up with this number in order to do this ratio. So there's kind of the caveat with this ratio. But this is the operation of the ratio right here. It's going to be simply this first calculation is my revenue multiplied by the percent of sales that I'm just assuming that I made on credit because I don't actually know in this case. You would really need to know if it were your own business. So that I get that 10% of my sales were on credit, 2.6 million, something on that order. And then I divide that by my accounts receivable and I get a number of 3.54. That means I turned over my accounts receivables 3.5 times during that year. That's 3.5 turns. I convert that to days by doing 365 divided by the accounts receivable turnover ratio, and I get 103, meaning it took 103 days on average for my customers to pay me. Now, we should compare that to an industry standard to see how that is for this industry. And I have no idea because I just made up a business to illustrate some information here. But you would presumably know what your industry standard is in your industry, or you would be able to figure that out, look that up. Have your accountant look it up when they come up with the report. You need some number to normalize this against so that you understand if it's a good number or a bad number. Now, I'm looking at that, and just my old-fashioned common sense tells me waiting 103 days to get paid, that sucks, y'all. Okay, that is not good. 103 days is far too long. The standard in business is a 30, 60, 90, where you got 30 days, and then you get a fee added to it, and you have 30 more days, 60, and then another fee added to it, and then in 90 days, that thing's going to have to go off to collections because you haven't paid in 90 days, and there'll be more fees added to it. So this is more than 90 days. That can't possibly be good. But it improved. It went from 3.5 turns a year to 4.16 turns per year. What is that, 4 1/8 or something like that? And now we have the average days to receive payment below 90. Hey, that's a pretty good start. I'd like to see it below 60 or even better below 30 because waiting on other people to pay you puts you in a cash flow pinch. Remember when we went over these liquidity ratios here, right? Consider this acid test ratio. If you get your accounts receivables turnover ratio better, right? If you get more turns a year, if the days it takes you to get paid goes down, you have less days to get paid, right? It takes fewer days for you to get paid. This acid test ratio is going to improve. And this acid test ratio is a real great measure to see just how far off you are from having the cash you need to get the job done. Likewise, the current ratio and the quick ratio are also going to improve as you are turning things into cash. So turning receivables into cash doesn't affect those two ratios. It's the acid test that it affects. So let's be accurate. It won't impact these top two, the current and the quick, but it will affect this acid test ratio because you're turning something not on the ratio into cash. So let's scroll back down to our activity ratios. All right, where do we go? There we are. Now, the next thing is the accounts payable turnover ratio. So this is kind of the opposite of the accounts receivable turnover ratio. This is telling you how good you are at paying your suppliers, because what happens is you order something from your suppliers, it shows up, they send you an invoice, and they say, pay within 30 days or we hit you with a fee. And if you don't make 30 days, they invoice you again and say 30 more days or an even bigger fee, and on and on and on. That's typically how it's done. It's just like your electric bill or your cable bill or your house payment. There's a late fee if you don't pay it on time. And once again, I've kind of made some heroic assumptions that you've spent 50, 60% of your purchases on credit, meaning you didn't pay cash for them at the time and you were billed for them and you paid them later. And we have an accounts payable that we pulled off of our balance sheet. Once again, this should probably be the average accounts payable beginning of the year versus end of the year. I don't have the information to calculate that, but it's probably the better way to do it, okay? And the amount of total purchases. And so we assume that half of our purchases, or 60%, depending on the year, are to credit, and then we just do a little division. It's going to be our purchases on credit, which is what this first thing calculates, divided by our accounts payable, which is the second part of this fraction here. And we get a number 12.19 turns. From turning 12 times a year, which is slightly less than once a month, to turning 26 times a year, which is twice a month, right? So we got better. We went from once a month to twice a month. The days to make a payment, exact same thing. Because we had 365 days in a year. Now remember, if we're doing a quarter, there's less days in a quarter, okay? We do 365 divided by our turnover ratio, and we get 29.94, meaning it took about a month for us to get someone paid, which kind of makes sense because you got to get them paid in a month to avoid late fees. And we cut that in half. We went from a month to about 14 days. So we did a better job of that. Or did we? Because here's the thing to remember. This is where someone else is extending us credit, and they're not charging us any interest on that credit. And the late fee we pay is the same at 13.66 days as it is at 29.94 days. It is my opinion that while it was a good thing to go ahead and pay our bills a little bit quicker, this business paid them just a hair too quick. Basically, you've got half a month where you get to use someone else's money for free when you wait until 29.94 days to pay that bill. And that's something to keep in mind when you look at these things. Yes, it's definitely better to pay your bills earlier, but the gain from paying it once a month to paying it twice a month isn't much of a gain. So those are 3 activity ratios that you can use to analyze your business. I really think this inventory turnover ratio is super important because churning through that inventory is how you make that money in most businesses. You're looking at retail businesses, you're looking at farm supply businesses. It doesn't matter if farm equipment businesses. Inventory sitting there not moving is really expensive. You're probably paying interest on that stuff. You got to flip that inventory, and flipping it quick is a good idea. All right, so that's some activity ratios. We're going to break this down into one more video, and we'll pick up some ratios on profitability.